All right, pause your scroll for a second, because something just snapped in the silver market. And it didn't happen over weeks or days, it happened over hours. I'm talking about silver printing over 121 in Western spot markets, while at the exact same time, China is trading silver north of 146. That gap didn't slowly drift open. It blew out. And when you see a $20+ premium appear basically overnight, that's not noise. That's a system screaming. Stay with me here because I'm going to walk you through what just broke, why it matters right now, and how you can spot this kind of market failure before it hits headlines. If you're watching this right now, you're ahead of the curve. Your job is to understand what this signal actually means before everyone else figures it out. Now, before I explain what caused this, let me teach you something most people never really internalize about commodities. There are two prices that always exist at the same time. There's the paper price, which is what futures and derivatives say something is worth. And then there's the physical price, which is what real buyers pay when they actually need delivery. Think of it like airline tickets. Online, a seat might say $500. But if there's one seat left and you have to be on that flight, suddenly the real price is whatever it takes. Silver works the same way, and right now those two prices are no longer even pretending to agree. Here's what you need to know about silver specifically. It's not just a shiny hedge, it's a critical industrial input. Solar panels, electronics, defense systems, medical tech, this metal gets consumed. It doesn't come back. And for years, the market papered over supply shortfalls by promising future delivery instead of delivering metal today. That works until it doesn't. When experts look at commodity markets, they're looking for one thing above all else. Delivery stress. That's the canary in the coal mine. That's what tells you when paper promises are about to collide with physical reality. So what does that tell us? It tells us that price discovery breaks, when the thing being traded can't actually be delivered at the quoted price. And that's exactly what we're seeing right now. If this is making sense so far, drop a comment below and let me know where you're watching from. I want to know if you're already holding silver or if you're trying to figure out what this means for markets in general. Now here's what's actually happening. Let me break down the sequence because this is where it gets interesting. First, global silver supply has been running a persistent deficit. Not for 1 year, for multiple years. Mines aren't scaling fast enough, grades are declining, and above-ground inventories have been quietly draining. You've got major producers dealing with ore bodies that are literally producing less silver per ton of rock than they were 5 years ago. That's not a short-term problem. That's geology. And when you're pulling metal out of the ground slower than the world is consuming it, eventually the math catches up. Second, physical demand hasn't cooled. In fact, it's intensified. Solar installations are still accelerating globally. Technology demand is sticky, and investors, especially outside the West, want bars, not promises. They want metal they can vault, metal they can touch. When you've got industrial users competing with investment demand, and both of them competing with strategic buyers, you've created a supply crunch that can't be solved by printing more futures contracts. So when China steps in and says, "We'll pay 146 for real silver right now," that's not speculation. That's a bid for metal. That's someone saying, "I need physical delivery, and I'm willing to pay $25 over the Western spot price to get it." At the exact same time, refiners like Perth Mint and Metalor halt new orders. That's the confirmation signal. That tells you the bottleneck isn't price discovery, it's physical availability. These aren't mom-and-pop operations. These are major refineries that process thousands of ounces a day, and they're saying, "We can't take your order right now because we don't have the metal to fulfill it." And when vault inventories start dropping while premiums explode, that's convergence. Paper says one thing, reality says another. You've got COMEX inventories that have been sliding for months. You've got eligible stocks that are supposed to be available for delivery, and they're shrinking. Meanwhile, premiums in physical markets are spiking to levels we haven't seen since 2020. That's not a coincidence. That's cause and effect playing out in real time. But here's the part that should make you nervous. This spread isn't just a price difference. It's a credibility gap. When futures markets fail to deliver metal at the quoted price, participants stop trusting the quote, and once trust goes, liquidity follows. That's when margin requirements rise. That's when exchanges intervene. That's when volatility stops being theoretical and starts hitting accounts fast. You've seen this movie before, even if you didn't realize it at the time. Every time a commodity market breaks down like this, it follows the same script. The paper market keeps pretending everything's fine, while the physical market is screaming that something's wrong, and eventually the physical market wins. It always does. Now let me show you what very few people are talking about. This isn't the first time we've seen this exact pattern. Zoom out with me for a moment. This is the exact same playbook we saw during the 1980 silver spike, when physical demand overwhelmed paper control. Back then, you had the Hunt brothers trying to corner the market, sure, but underneath that narrative was a real supply squeeze. What happened next? Silver went from single digits to $50 an ounce in less than 2 years. The lesson? When physical delivery breaks down, price becomes whatever someone's willing to pay for actual metal. Fast forward to nickel in 2022. The London Metal Exchange literally had to halt trading because prices no longer reflected reality. You had a massive short position that couldn't be covered with physical delivery, and the market went vertical. Nickel spiked from $20,000 to over $100,000 per ton in 2 days. 2 days. The LME stepped in, canceled trades, and basically rewrote the rules in the middle of the game. Same pattern we're seeing today. Too many claims on too little metal. And it echoes gold in 2008 and again in 2020, when physical premiums blew out while futures lagged behind. In 2008, you could buy gold futures at $800 an ounce, but try to get physical delivery and you were paying $900, $1,000, sometimes more. In 2020, during the COVID chaos, premiums on 1-ounce gold eagles hit $200 over spot. Every time this happens, the trigger is the same. Too many claims on too little supply. When you look at the pattern, the price move is never the story. The breakdown in confidence is. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this cool off? Absolutely. Could exchanges raise margins, cool speculation, and compress price temporarily? Yes. They've done it before and they'll do it again. Could governments lean on markets to restore order? That's always on the table. And not every premium spike turns into a straight line higher. Sometimes these things revert. Sometimes the physical market calms down and the spread compresses. Here's the thing though, it doesn't actually matter whether this was orchestrated by central banks or driven purely by market forces. The mechanics are what matter. You don't need conspiracy theories to understand this move. You just need to watch flows, inventories, and delivery stress. Focus on what you can verify, not what sounds dramatic. Can you verify that premiums are elevated? Yes. Can you verify that refiners are halting orders? Yes. Can you verify that inventories are declining? Yes. Start there. Everything else is commentary. There are probably 3 types of people watching this right now. Some of you already hold silver and you're thinking, is this finally it? Is this the move I've been waiting for? If that's you, let me be really clear. Your job isn't to get euphoric. It's to manage risk, understand volatility, and know your exposure. Silver can move 5% in a day. It can give back gains just as fast as it puts them on. If you're overexposed, this kind of volatility will shake you out at exactly the wrong time. So check your position size. Make sure you can actually hold through drawdowns. And don't let euphoria turn into recklessness. Some of you are watching from the sidelines, feeling like you missed it. You're seeing this move and thinking, I should have bought when it was cheaper. Let me be honest with you. You don't chase vertical moves. You study them. You wait for structure. Maybe that's a pullback. Maybe that's consolidation. Maybe that's a clearer trend. But jumping into something after it's already moved 20% in a week, that's not investing, that's gambling. And the market will punish that every single time. So be patient. Learn from this and wait for your setup. And then there are those of you who don't own silver at all, but you're trying to understand what this says about markets in general. For you, this is a masterclass in how price signals fail when supply chains break. This isn't just about silver. It's about understanding the difference between financial claims and physical assets. It's about recognizing when markets are stretched beyond their ability to deliver. That principle applies to everything from oil to wheat to rare earth metals. Different paths, same principle. Don't outsource your thinking to a headline. So here's what I want you to answer in the comments. Which category are you in? Are you holding? Are you watching? Or are you trying to learn the pattern? Let me know, because I want to understand who's watching and what you're trying to figure out. So here's where I stand. I'm not pounding the table. I'm paying attention. Let me tell you what I'm personally watching. First, I'm watching physical premiums, especially outside Western markets. If those premiums stay elevated or widen further, that tells me the delivery stress is real, and it's not going away. If they compress quickly, that tells me this was a temporary squeeze and the market's finding equilibrium. Second, I'm watching delivery volumes and any sign of forced cash settlement. If you start seeing futures contracts that are supposed to deliver physical metal getting settled in cash instead, that's a red flag. That means the exchange is admitting it can't deliver what it promised. Third, I'm monitoring policy responses. Margin hikes, trading halts, narrative shifts from regulators. When markets get unstable, intervention follows. And how they intervene tells you a lot about how serious the problem is. Based on my analysis, this move was mechanical. It was structural. It wasn't driven by emotion or speculation. It was driven by people who need physical metal bidding against people who also need physical metal, and there's not enough to go around at current prices. The fundamental picture didn't weaken here. It validated the stress. You've got supply deficits that have been building for years. You've got demand that's not slowing down. And you've got inventories that are draining. Those fundamentals don't change overnight. If history rhymes and silver holds above 100, the move that follows could be significant. I'm not making a prediction. I'm showing you the pattern. And the pattern says that when physical markets decouple from paper markets, the repricing can be violent and sustained. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Don't take my word for it. Check the data yourself. If you made it this far, you're the kind of person who thinks independently. That mentality will serve you well. If this breakdown helped you understand what's happening, hit that like button, share this with someone who needs to see it, and subscribe if you want more analysis like this. I'm breaking down market moves that matter, teaching you how to spot the signals, and helping you think critically about what's actually happening beneath the headlines. This isn't the end of the story. It's the chapter where the market reveals what it's been hiding. Stay sharp out there.